Continuing on in our series of videos on hedging. My previous video was an introduction to hedging. If you have not yet watched that video, you can find the link here. Now on to Emini S&P Futures. Before that, let's understand what the S&P 500 index is. The S&P 500 is an American stock market index that includes 500 of the largest companies by market cap that are listed on the NASDAQ and NYSE. This is a vital indicator of the stock market's health. The S&P 500 is one of the most popular investable instruments worldwide. Initially, the index consisted of fewer companies and the shares were cheaper. Investors could directly purchase it. When the number of companies included became larger, their shares became more and more expensive. It became very hard for investors to buy these shares. This is when ETFs and futures contracts came to the rescue. Today, investors can buy the S&P 500 by simply purchasing an ETF or a futures contract directly from their broker. In order to make the S&P 500 more accessible to retail investors, Emini S&P 500 futures contracts were launched. And this requires significantly less capital to trade. The Emini contract represents 1/5 the value of the S&P future contract. This means that investors with smaller portfolios can also hedge using Emini futures and speculate the market without taking the dollar risks of trading S&P 500. The ticker symbol for Emini is ES. Remember that Emini in general refers to Emini S&P 500. But Emini futures contracts are available for other indexes such as the NASDAQ 100, Russell 2000, and Dow Jones Industrial Average as well. Now the Emini has a contract multiplier of $50. Minimum tick of quarter point and a dollar value of one tick equal to $12.50, which means a full 1 point move in the S&P index is worth $50. So if the S&P gained 10 points, then the value of the Emini futures contract is 50 times 10, that is $500. Eminis trade Sunday 5 p.m. Central Time to Friday 4 p.m. Central Time. It is very essential for futures traders to understand margin requirements. In order to enter a futures position, you would need a margin which is a fraction of the contract's notional value. This is known as the initial margin. A maintenance margin is a minimum amount of equity that an investor must maintain in the margin account after the purchase has been made. Let's take a look at an example of a trader having an account worth $7,050 and is bearish on the S&P and decides to short the ES futures contract. Let's say ES is trading at $3,000. So the notional value of the underlying contract is $3,000 multiplied by the value of the contract multiplier, $50, which is $150,000. In other words, if you had to own a portfolio that reflects the S&P 500 with the same value as an ES contract, you would have to invest $150,000. However, by using futures contract, you can put down a fraction of contract value, and this is usually 3 to 12%. So in this case, let's take the initial margin to be 5% of the notional value, which is $7,500, and the maintenance margin to be almost $7,000. Let's say the next day the S&P 500 fell by 5 points, and each point on the ES is equal to $50. So the trader gained $250. Futures contracts are cash settled at the end of each trading day, which means daily gains or losses are credited or subtracted from the account. In this case, the trader will have $250 credited to his account at the end of the day with a balance of $7,750. The next day, S&P rises by 30 points, so the trader would lose $50 times 30, which is $1,500. That is, his account will have $6,250, which is below the maintenance margin. The trader will now receive a margin call and can do one of the following: deposit cash to maintain the initial margin, exit the position, or the existing position appreciates. Let's say the next day the S&P 500 fell by 35 points, which means the trader's account has gained $1,750 and now is equal to $8,000. His account balance is above the initial margin and is above the margin call. If his balance had not appreciated, he would have to deposit cash or exit his position. Now, if the trader chooses to exit the position before expiration, he would end up with $8,000, which is a $500 gain from the initial amount of $7,500. That is a 6% return. Here we go. I hope this video helped you understand Emini futures and how movement in the index can incur profit or loss on the futures contracts. I have added the link to join our Discord server in the description, and feel free to leave a comment for any queries. Happy trading everyone, and have a great day.